the value investing and yield type investing over a generation, it causes secular stagnation. And this is something that, Peter Thiel has absolutely nailed. It's why he's in VC, is because you want to invest in new ideas. There's usually technological unlocks that help grow the next generation for nominal growth. But we did this, I think it's stupid to risk adjust your returns institutionally and have it mandated. I get that as a boomer, you want to have less risk and save your money. But, when you do it institutionally through pensions, through endowments, and you scale this for a generation, you end up to the point where that building that you bought, that commercial real estate building that you thought was money good and it yielded 8% every year, bam, it takes a 75% haircut. And you don't, no one's in office buildings anymore because the economy changes, because the next generation doesn't need it. And so this idea of risk adjusted returns, it's like it might be flipped. So risk adjusted returns, short volatility, these were like the predominant ideas of the last 40 years. And what it did was it just took money from, the capital class took money from the middle class. And that's what happened. And there was a pocket of frontier investing and growth investing, but relative to the yield investing, it was like a drop in the barrel. And that's why we have such a hard time seeing nominal growth. Not only that, but the nominal growth, normally when people feel wealthy and they feel rich, they have children, and you can see it in the fertility rates dropping, is the next generation is not getting wealthy because they've squeezed all the juice out of this, short volatility trade. And so my thing is, the government, to make up for the growth, we're moving to fiscal dominance. The government is forcing you to invest on the frontiers. They're enforcing you to invest in the growth sectors of the economy that have big TAMs, and they're literally creating infrastructure plans to invest in AI infrastructure, to invest in data centers, to invest in manufacturing. And these are all the things that have been neglected for 40 years in short volatility land. So
hey, everyone, and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of working on Tyler Neville. Tyler has 20 years experience trading a hedge fund, specifically sort of with derivatives and equities, as well as working at Franklin Templeton, obviously a massive asset manager, one of the largest in the world. And he's also been a part of Real Vision and sort of Blockworks as well. So Tyler, thanks so much for coming on the podcast today.
Of course. Thanks for having me.
Yeah, looking forward to the conversation. And we're just talking about before that we'd booked this interview to record, and we completely forgot that it was Jackson Hole and that Fed Power would be throwing out all this stuff.
A lot's happening, but it should be good timing.
Yeah, 100%. And it will be going up next week. So hopefully not everything's changed since then, but at least we can get a fresh perspective on, that's where I'd like to start, on your thoughts of what you saw. And it's interesting. I listened to one of your sort of podcasts where you have with Forward Guidance, and you were saying that everyone's so sort of bearish, everyone thinks it's going to be so hawkish, and you were saying it's probably going to be the exact opposite, and it has been the exact opposite. So
I mean, I got this one right, but you don't want to get too cocky and have it go to your head. So what I do think I got right, at least, is the framework, which is we have to roll $7 trillion of debt this year in treasuries, and I think the policy is shifting to be a policy of basically financing the treasury instead of worrying about the dual mandate. I think he talked about that, but I think the real truth is where things are. We've basically turned into a Ponzi scheme, and you have $1 trillion of interest rate expense per year on the government balance sheet, and it's largely controllable by rates. So I think they're going to have to markets. I say markets have turned into a political utility, and that's largely what happened at Jackson Hole. Now is Powell looks like he caved to Trump. He's going to cut in September, and now the market's going gangbusters. So I think it's game on. But the truth is that we need to delever the government balance sheet through nominal growth. And the new policy should be, we're going to have negative real rates, meaning, if inflation's at 3%, you're going to have 2% rates, and you lose 1% on those. So that will help delever the economy, where you go out on the risk spectrum, nominal growth rates should go up, and you can kind of use the S&P as the piggy bank for tax receipts. Capital gains tax will help lower a lot of the problems in the economy here. So
Yeah, interesting. And I guess the challenge that they've had recently is that we had the 100 basis points last year, but actually yields went up. So do you think that was going to be an issue as well, where they're going to continue to cut, but obviously deficits are way out of proportion? They're absolutely massive. People are concerned about the continued issuance of debt, so potentially it might not actually reduce the borrowing costs for the US government.
Yeah, and just run it hot and have growth rates go high. See, I think that was where part of the framework is. If they actually tightened or kept it more restrictive, I think you would have had, high yield bonds sell off. Then you have credit problems. You already have a lot of stuff going wrong in the economy, in certain parts of the economy, which is why they were forced to essentially ease. Commercial real estate is taking 75% haircuts in major metropolitan areas. I don't know if that's the same in the UK, but that's a lot of tax dollars that flows to some of these cities. I mean, 75% haircut on a $500 million building is wild. And that will immediately affect cities. And think about the infrastructure. So you have less tax revenue that comes to cities because of this commercial real estate problem. And then more money has to go into the pensions because they're still unfunded. So like if you didn't lower rates or hint at lowering rates, there's a whole cascade effect from the leveraged finance economy and the real estate economy that could have just gone, really caused some sort of credit crisis. And I think they're aware of that. That's the great part about, contemporary, all the data now is you see it and you can react, but like they can't outright tell you they're going to use negative real yields and delever the economy and keep the growth rates higher. But they did it. They hinted it. They're just going to nudge it slowly. And that's largely, since it's a confidence game, you can't just outright say, oh, we're doing yield curve control, or, oh, we're going to lower rates. You have to just incrementally nudge things. And that's why the market just keeps grinding higher in the face of all this. And then another one of the dynamics that happened into Jackson Hole was, and this is so consistent on every single event, is hedge funds are largely too smart for their own good. They use derivatives and they buy downside protection, and they degross their books. That was largely what happened the first couple of days of this week. Is they sold their winners and they covered their shorts into this event, and now they're underinvested. Now they have to chase, and vice versa. The VIX was up, which is they bought VIX calls to hedge their books, and now the VIX is down 12% and the IWM's up 4%. And like a lot of this market structure stuff is where I really spend a lot of my time, because the whole risk adjusted returns philosophy in the hedge fund management industry and like low volatility type management has caused this market structure. And because it's mandated, if you have a beta neutral hedge fund, a lot of this stuff is mandated that you can't have much exposure. And so you're constantly, hedging out all your returns. And so it's so consistent. We see this all the time. We're going to see it into NVIDIA earnings next week. The vol curve is already, anticipating it's up on NVIDIA earnings. And likely you'll see the VIX come rolling, crashing over once that event risk is gone. And the market will continue to grind higher with buybacks. So that's kind of my framework. And it's worked in this world. The last thing I'll say on Powell specifically is like, we have a 6% deficit. And if we did go into some sort of recession, there's this great work by this guy, Robert, who does Infranomics. And he shows you what would happen if you just had a garden-led recession is the deficit would blow out to 15%. And the Treasury would have to issue ungodly amounts of bonds. So Powell, I think, got the message and knows that you essentially this is a Ponzi. You can't taper a Ponzi, and that's, you just have to finance the Treasury until you get back into some semblance of a lower debt to GDP.
Yeah, and there's a lot of people who are saying that actually higher interest rates are stimulatory to the economy. So maybe they're actually even driving potentially this inflation and what's happening. So potentially cutting rates could almost have the alternative effects to things and contraction.
It's really interesting, and I don't know Judging from price action, the 10-year yield is down, 30-year yield is down today. The yield fell, and everyone's saying, oh, you got to short bonds now. But the government has so much control over where they can issue on the yield curve. So if you could just issue, if you lower rates and you can issue on the front end of the curve, you don't have to issue on the back end of the curve, and everyone's short on the back end of the curve, it causes a massive squeeze. So my general thought on this is that if you lower interest rates, you reduce the cost of capital, which means you can oversupply things that are commoditized. You can use the debt markets. Like what we saw when rates were really low is oil went to zero because a lot of these oil companies, they could issue debt, high yield debt, and then they oversupplied the market in the US is they used the bond market when capital costs dropped to basically like pump more oil. So it's actually net disinflationary. And you could probably make the argument like as rates go lower, like high yield spreads are in, high yield HYG is breaking out to the upside here. It's why IWM is breaking out up 4% today. But when you lower, the rates, especially in more risky companies, a lot of those risky companies have to oversupply the market. It's kind of like what's going on with China right now. In China, they pivoted from a real estate-led economy to a manufacturing industrial economy. And so they levered up first the real estate market to grow. And now they levered up, the manufacturing capacity. And since they're so in debt, they have to produce more and more and more goods because they made the financing available for manufacturing. And that could be massively disinflationary. So like it could be counterintuitive where you lower rates and it actually causes things to be less inflationary. And you just go out on the risk spectrum because the cost of capital drops for the riskier types of companies. And which is why I think we're seeing like ARKK is just, it's like a picture perfect chart. This is, the ARK Innovation Fund. And when the cost of capital drops, you go to crazy shit that's overvalued. That's just how it works. Can I swear on here?
Yeah. Fine. Don't worry.
Yeah.
Have to with these markets.
Totally.
This is a good place to sort of go into, the last 40 years. And I think we look at it, sort of value investing, risk adjusted returns. You sort of mentioned a little bit and how it drives markets and maybe how it's shaped our economy as well, especially I guess in the West more generally. So I'll be interested to hear how you see that.
Yeah. I spent a lot of time, I was trading, volatility at this Franklin income fund. It's a 60-40 portfolio. It's a $100 billion fund. And, what you did there was essentially you took equities and you overwrote those equities with call options to generate some more yield on your equity portfolio. And it was a short volatility strategy. So you essentially just, you're any pop in volatility in a stock that's not supposed to happen, you can sell calls and you generate a couple more percent to make the yield on that portfolio. And so that idea, it's the same premise as, what Warren Buffett, the life insurance model, where you take in premiums from, offering life insurance and you go reinvest those in a yielding asset. And so this was like the predominant, risk adjusted returns is the predominant, I guess ethos for the past 40 years is like, I can just borrow from the short end and then buy something at a higher yield and I make that spread. But what you do for a generation when it's just, you don't invest in new things, you're basically just arbing things. And I think that's largely the Warren Buffett model is like, the value investing and yield type investing over a generation, it causes secular stagnation. And this is something that, Peter Thiel has absolutely nailed it's why he's in VC is because you want to invest in new ideas. There's usually technological unlocks that help grow the next generation for nominal growth. But we did this, I think it's stupid to risk adjust your returns institutionally and have it mandated. I get that as a boomer, you want to have less risk and save your money. But, when you do it institutionally through pensions, through endowments, and you scale this for a generation, you end up to the point where that building that you bought, that commercial real estate building, that you thought was money good and it yielded 8% every year, bam, it takes a 75% haircut and no one's in office buildings anymore because the economy changes because the next generation doesn't need it. And so this idea of risk adjusted returns, it's like it might be flipped. So risk adjusted return, short volatility, these were like the predominant ideas of the last 40 years. And what it did was it just took money from, the capital class took money from the middle class. And that's what happened. And there was a pocket of frontier investing and growth investing, but relative to the yield investing, it was like a drop in the barrel. And that's why we have such a hard time seeing nominal growth. Not only that, but the nominal growth, normally when people feel wealthy and they feel rich, they have children, and you can see it in the fertility rates dropping, is the next generation is not getting wealthy because they've squeezed all the juice out of this, short volatility trade. And so my thing is the government, to make up for the growth, we're moving to fiscal dominance. The government is forcing you to invest on the frontiers. They're enforcing you to invest in the growth sectors of the economy that have big TAMs, and they're literally creating infrastructure plans to invest in AI infrastructure, to invest in data centers, to invest in manufacturing. And these are all the things that have been neglected for 40 years in short volatility land. So that's the end game, is you have to stay ahead. And not only that, but now the Fed is clearly out of the bag, diluting the currency. Raul Paul talks about it's like a 8 to 10% hurdle rate of dilution in your currency. So you actually can't get that return. Even in the high yield market, I think a high yield bond is it's probably at like 6-7%. So if you buy that, you're losing 1% a year as a high yield bond, let alone some of the other stuff. So what are you going to do? Are you going to invest in a high yield bond at 6%? Or are you going to invest in something that, potentially has the government backing it, like crypto or Bitcoin or AI infrastructure stuff? One of my biggest themes right now is the AI infrastructure names, which are Bitcoin miners largely. Is you can now issue you can issue debt at say 10+%, which will get you that real yield as a pension. And that means these Bitcoin miners can use the debt markets to finance and not finance through equity or secondary offerings, which means their equities are now actually going up. And not only that, but there's a long runway of growth for the AI infrastructure names, because there's not enough power for all the data and capacity and electricity that these AI hyperscalers need. And so that's sort of the things that I think you have to think about risk differently here. If you want to just be beta neutral, I don't think that model is going to be working in the next 10 years with where the government's at. And you really have to revisit what risk means to you, and buying a bond and sitting on it. Maybe it makes sense for a boomer. One of the things I've been talking about lately is Vanguard is saying, hey, have a 70% allocation in bonds. That's what you should do. And maybe if you're almost dead, that's a good advice. But no one in their right mind, especially after Powell's speech, would ever put money in bonds. I think bonds are a way you lose money slowly. So it's almost like where you park your money just in case, until you know what you want to do with it next. And so for offering a 70% allocation in your portfolio to bonds, you're just going to lose money. Here's a way to lose money slowly, and I'm going to charge you a fee for it. How upside down is that for a business model? And I think it's all generationally changing here, and you can see it in the politics. You can see it, there's a whole ethos changing that our generation is now getting more vocal about it and saying, this doesn't make sense. None of this makes sense. And that's, then we look at Bitcoin's up, it's almost near all-time highs. And that makes a lot of sense to me because all the other stuff does not make sense.
Yeah, there's so many places we could go through that. Lots to unpack. I guess you mentioned that there was sort of, the last 40 years is sort of taken from the middle class to the capital class.
Yeah.
I guess you could also say that it has been generational as well, in terms of the people who own the assets have massively benefited over the last 40 years with basically real estate increasing in every country. And that's what has driven most people's net wealth, has been the ownership of these real estate, and has made it very difficult for sort of younger people to jump on the ladder. So that is quite an interesting aspect as well, has been this, not just I guess, class, but also generational shift.
Yeah, and you know, if you have assets and you can borrow against them at low rates, your inflation of assets went up asymmetrically relative to the wage growth. And I think the next generation is really feeling that, and they're being like, dude, how did we get here? I can't even buy a house. How am I able to have children if I can't even afford any of this stuff? And luckily I'm a little bit older, and I got lucky when rates were low, and I was on the front end of like the Gen X millennial. But the next generation is really freaking hard to catch up here when the inflation's so bad. So I think what the policy really is with Powell is now, like, we're going to make the next generation, implicitly, we're going to put the next generation, whatever they own, they're going to start getting relatively wealthier at a higher clip than the boomer assets. And that's pretty much where you have to put your money at this point. And if the irony of the whole thing is, if they ever are hawkish and they're ever like, oh my God, inflation's getting bad, the bottom is going to fall out of the bond market. So that's why I effectively call it a Ponzi scheme. Like, they can't taper it. They'll never be able to taper it, because you need to have just growth rates in other parts of the economy go like wildfire to pay for all the debts. Because you can't have the growth rates in real estate that you utilize to run the economy or the government anymore, because you can't tax them at the same rate. So they're just going to run it hot, and that's the new policy here.
Yeah, it was back to the 60s or 50s where, if people bought the war bonds, they basically lost 70% of, or a ridiculous amount of the actual sort of value of that over the next 20 years. And it seems like that, as you mentioned there with Vanguard, 70% ownership, that they're recommending that in sort of bonds. They're probably going to do that as well with maybe the older, wealthier generation.
Yeah, it's sad if you're not conscious of that or that history. And the other thing that I keep going back to is, what are these centralized asset managers really there for? Is it to really do the right thing for the pensioner or the 401k, or is it to finance the government? Because, like, no private, like, small, if mom and pop, if I had my own investment shop, I would never ever just dogmatically say that that's the case. And this is coming from Vanguard, who made you invest in the 100-year Austrian bond, that was yielding like 0.25% back in 2020, and they're sitting on a 40% loss. Like, the mechanism of how money gets into the 401k system in the US, and I don't know if it's the same in the UK, is so co-opted that it's actually caused the secular stagnation, right? Like, if you automatically have every person in the country into this, public mandated type of thing, it's why some of these guys who do VC really well make so much freaking money, because there's no supply of capital, and it's starting to flee over there slowly because the returns are so asymmetrically better. And so you have to think about risk differently. You risk adjusted, 40 years, and now, these guys are just making asymmetrically more money. And Trump knows this, and that's why he's opening up the 401k system to crypto, to private equity, and to all these other different things now. I've been calling it like Weimar America, because there really is no other way out when you have a 130% debt to GDP and 6% deficits. You can't do anything else. And a lot of these guys that are economists, they've been so consistently wrong about everything because they have the wrong bottoms up framework of like how things work. And it's taking a small piece of financial history instead of hundreds of years of financial history, where governments will always finance themselves and look out for themselves. It's like things will always centralize until they don't. And now I think we're at the point where it's worse to be bigger than it is to be, like, it's way worse. You have a bigger target on your back being a giant centralized asset manager than being an F-16. Like, being an aircraft carrier of capital, it's so much harder to get returns than just being a fighter pilot. And I think that's what you're seeing. It's like retail has been absolutely crushing the institutional crowd. Like, and at some point it won't make sense. Like, the returns will be so good in this other pocket that they'll have to flee. Some of that money will slowly be fleeing over. It's just that when you mandate things, that's why it's so hard to like undo that whole process. But our generation will, because we understand it's so messed up. We're forced to invest in some things through our 401k that are so bad for our generation, and you can't opt out of it. It's the whole system is set up so poorly. And I get why they did it, but like when the road to hell is paved with good intentions, and we're just seeing all of these things hit like right now because the next generation's having kids. They're hitting 30s. They're getting into relationships, and they're like asking these questions finally when they were pretty much pillaged for a generation of offering student loans and getting your kids in debt, and now it's all coming home to roost.
Yeah, it's financial nihilism. It's like I don't have any other option. I basically need to put it all into the highest risk assets possible to hopefully have the point of
yeah.
The
other thing is like a house is for some people, the house is so financially like unaffordable. If you look at the unaffordability chart, I don't know if you can overlay that. I think that's another reason why Powell's lowering rates is it's so absurd. You might be making an okay wage, and you're saving money, and that's why these kids go on the trips, because you used to be able to save for your mortgage. You'd have to save for your mortgage and pay for that. And people are like, it's so far out of reach that they'll go travel and see their friends instead, or go out to dinner and have like little affordable luxuries instead of a $2 million mortgage for a shithole house. Like I don't, you probably have this in London, but in San Francisco, I lived there for years, and I remember looking around and to my wife, and there's these like houses for like $1.5 million. And we were about to have our first child. And I'm like, this thing's a dilapidated shack. Like the amount of money you'll have to put into like for CapEx every year is horrible. And it's so insane. So we moved to Texas. And I think that's another big, huge theme was, it's probably in London too. I think we talked about this off camera, but the next generation is going to move to where they're treated the best, and it's low income tax places. Corporations are moving to lower income tax places, and in the other places that we thought were hotbeds of economic activity have actually, it's been like a vice on the next generation, where you slowly get squeezed by the inflation there because they have to pay for unfunded pensions, they have to pay for infrastructure. None of that stuff really flows through, and the taxes are only going higher in those jurisdictions. And I say this a lot, but like Texas has a $30 billion surplus because a lot of people are moving here and companies are moving here, and they treat the taxpayer right. They take care of the infrastructure. There's law and order, and if you look at Chicago, it's almost the opposite. They have like commercial real estate buildings are falling 75%. They're saying, hey, we're going to tax the rich, which is going to cause an exodus of all the rich people. And the schools are getting worse. It's really terrible. And I think that's also partly why, you have to have, we're at the Weimar stage where you have to have nominal growth just so the old legacy systems can keep functioning.
Yeah, and I think personally that's maybe a reason why the US does do well over a longer period of time, whereas in the UK there's different regions, but they don't have their own tax rates, they don't have their own they have policies, but a lot of the time they don't actually have much control. And I think it does get to the point of the tax rates as well. That has a massive impact on people who will actually leave the country versus continue to pay the taxes. Whereas in the US, you can sort of just move between states. You don't have to up and leave the whole area. And I think that's a lot of countries as well. It's actually quite a unique thing that it has.
And globally, we were talking about, I think a lot of people are leaving and going back to Australia or places, even though Sydney has a horrible housing bubble, but places where you have a better quality of life for the price, the value. And I think that's just going to be a secular theme from here on out, because people are sick of living in debt and living with inflation. And the internet has largely disintermediated a lot of stuff. If you can work and utilize these new AI tools and work as a satellite worker. I mean, I knew at Blockworks we had people from Brazil working there. You could work satellite from anywhere if you find the right company and you have the right interests. I know that's probably pretty high end problem for a lot of people, but there's Texas relatively. If I was in New York doing like a blue collar job and saw the inflation there, I would immediately move to Texas, and you can get paid twice as much and have half the cost.
Yeah, which is amazing. And I think, it seems like this is all linked into the fact, as you mentioned, it is a Ponzi scheme, basically. We can't cut deficits. Economy is probably not going to grow, fast enough to sort of reduce the debt. So it's going to have to be the currency that basically gets depreciated versus sort of assets, and especially these assets that we've talked about, like gold and Bitcoin and other things.
Gold's breaking out here today. It looks fantastic. Gold miners are making more and more money, and their margins are fantastic because oil really has stayed lower relatively in this whole thing. But I think those are the types of themes you have to play to stay ahead of the inflation from now on. And we watched a 15-year bear market in gold, and now it's coming back. And it's fascinating because no one's really, all the pensions are so caught up on other sectors, and they have maybe like a 1% or 2% allocation to any of this stuff. So where's the risk? Like, is the risk in the stuff that all the centralized asset managers own? I think Jim Carson, he says there's like $500 trillion of assets that are in like the, I guess, like pension endowment system. And then there's like 12 that are in the uncorrelated bucket, which is like precious metals, crypto, alternative structured products type of thing. And that's, you could theoretically see a massive, transfer into those new frontiers, as I call
them. Yeah, that would be crazy to think what impact that would have on all those assets. I think one thing you sort of touched on before was like, I guess, the Peter Thiel mechanism of investing, and I think it sort of links to, I guess, political philosophy and how you look at the world and how you look at the economy. So I'd be interested. Maybe you can go into a little bit more of that and how you see that and how it drives markets in your opinion.
Yeah, I mean, so he's obviously I would say he's been the most right on the macro. At heart, Thiel is just a macro guy, and I didn't appreciate how much of a polymath he actually was until I read this piece called The Straussian Moment by him, which synopsized like hundreds and hundreds of years of like history and political structures that really drive investment philosophy. And so, you start with a baseline of his thing is competition is for losers, where you want to think originally and always be investing in things that have like a monopoly. Like SpaceX is a great example. Is how many other companies go to space? Like there's a couple now, but like when he was doing it, nobody. And so you kind of, instead of an oil driller is the easiest. I shouldn't say easiest thing, but it's commoditized. Like there's a very predictable stream of income, et cetera. And a lot of people are doing it. So I think from that perspective, you have to think differently about stuff. From political, one of the things that I thought was interesting is I started taking like political philosophy classes with this guy, Michael Millerman, who's pretty brilliant, but he said, when in the Cold War, capitalism conquered communism, and communism was the big boogeyman enemy. And then we had, democratic capitalism and liberalism won. And for the next 40 years, we were in this system, and that was the water you're swimming in. The old David Foster Wallace, like, that's the baseline of everything, this political philosophy. And so you had, capitalism was this thing that we exported around the world. And now what happened is, you had liberalism on one side, and then communism on the other side. And now the whole system seems to be eating itself. Is like if you're any bit on the left, you're a communist to everyone on the right. And then if you're on the right, everyone on the left is a communist, or sorry, you're a fascist on the right, and then you're a communist on the left, and there's no in between. There's no like centrism. So Millerman's kind of like, it's kind of eaten itself, and we could be like emerging this whole new system, this this multipolar world that, I mean, they say this guy Alexander Dugin comes up with the fourth political theory, and which is outside of communism, capitalism, liberalism, and so it's got different components to it. But essentially, like, instead of this like hegemon unipolar world, you have a lot of different multipolar powers throughout the world, and then you'll have more like inline incentives, because like in a capitalist, democratic capitalist world, it was so globalized where like you inevitably, like, if you just take exports to from China in the US, is like, if you're Nike, you use slave labor to essentially, export cheaper shoes to the US, and you annihilated your manufacturing base in the US because they were too expensive. And you just gave the middle finger to the US because they were too expensive. And that was the unipolar world of US hegemony and capitalism. And I think that's run its course. And now you're going to have like more bastions of people sticking up for, nationalist, interests rather than foreign interests. And there was a great line Louis Gave had in one of the podcasts. He said, what the elites did in the US was the elites on the coast wanted their Hamptons house to be a $20 million house instead of a $2 million house. And the cost they paid was to annihilate the middle of America's manufacturing capacity and give them a fentanyl crisis. And like, it was something like those words. And that's really encapsulates the last 40 years, is like of what American business was just going to cheaper costs, forms of labor, and not caring about like the people that you have to live around on a daily basis. And that just dismantled the class structure. And I think the next generation is really starting to think about this from a political perspective. It's like, how do you run a society where it's more just and fair, and you're not just like issuing debt to buy back stock and make yourself like insanely wealthy? You actually have to invest in risk to grow things. Sorry, I'm probably just like going down a complete philosophical rabbit hole, but I think these are the questions we're finally asking ourselves, and we're moving from this system of like, pointing the fingers at you fascist, you Nazi, you communist, to a whole new thing of like, you can of whatever this new system is that we're emerging in. It is really fascinating, but I think it's going to be based off frontier investing. And the last thing I'll say about philosophy is Neil Howe has this fourth turning cycle. It's every 80 years. They go through 4 different seasons, and it's summer, spring, fall, and then winter. And winter is this period in an 80-year cycle where it's a lot of political angst, a lot of problems, a lot of intergenerational issues. Institutions are failing. It's like literally everything we've watched for the past 10 years is just infighting on everything, and no one can come to compromise. And I think we're moving as the boomers age out, and the Nancy Pelosi's of the world and the Chuck Schumers of the world, and a lot of the other Mitch McConnell's of the world go sayonara and see you later. This new system, this first turning, is emerging, and new institutions are being built. And so personally, I'm trying to bet on the new themes of the new, who's going to be the winners of that next first turning, who's going to be the leaders of this new world, and what technologies are going to be at the forefront of how we rebuild, this sclerotic, bureaucratic, globalist economy. And so that's political, probably too much political philosophy, but that, I really think that's the framework, the bottom line for everything. And then you just kind of build on top of that.
Yeah, it's such an important way to look at the economy, and I guess to think, as you said, where you should make these investments. And I guess the challenge that I have is, this would probably be good for middle America. It would mean more competition, there's probably going to be less efficiency in terms of these blocks are going to need multiple people doing the same thing, so then you have more employees and more costs. But then there's almost, you think it's a light at the end of the tunnel, but then there's this massive train actually coming towards you, which is AI, which could then basically reduce all these benefits and maybe even make it worse for the sort of middle America and for the jobs available. So I don't know, how do you look at that? and the impact that would have, because that's a Rao Powell thought where 6 years is, or 5 years is the economic singularity.
I go back and forth on this. You'll probably laugh at this, but I was like, if AI really works and it doesn't unleash new industries and new things for people to do, then everyone just ends up selling foot fetish pictures on OnlyFans, and humans just turn into sex workers. Like, what other purpose do you have? Like that's probably like where I sit 5% of the time, where you're like, okay, everything can be done by a robot, so what's left for human? I don't know. Even AI could probably do that stuff. It's kind of a dark thought, but I do think 90% of me thinks that this stuff. There was a great podcast I watched with this guy Carl Schulman on the Dorkesh podcast, and he goes, this productivity boom is going to be like nothing you've ever seen. Like, people can't even quantify. It could be like thousands of % in productivity, where like an average person, they could do 20 different jobs at once. They can do, at the click of a button, do 20 different things. And what that would actually do, like one other guy was talking about a new economy, new jobs that you never even thought you had, would be like, there's going to be jobs that basically go on the internet and tell you if it's true or not. Like, tell you if that's really AI or that's not. We never thought about that job, just like we didn't think about what an influencer was, or podcast. The podcast is a huge business now. And, I think all these things, like Amazon, we never thought was a business, but everyone was like, this is bullshit, it's not profitable. All of a sudden it's profitable. And like, that's the productivity boom. Like, if AI, it could make the centralized players, it could be so dismantling to them, if eventually, once everyone figures out how to use these things properly. So I don't know. I'm hopeful that, before it turns into Skynet and, we all get locked up as, energy for computers, and where humans become data servers, we can have a good economic growth and solve a lot of problems and create new industries. I do think that's probably the more likely scenario with all the doomsday stuff going on. But yeah, I'm not an expert in that, but I will say, I think it's more likely, having just seen, what Grok can do and what ChatGPT can do. It's really scary for a lot of white collar jobs. It's partly why I'm actually been more vocal on media and Twitter and doing podcasts, because like, when everything else is commoditized, influence matters a lot more, and the way in narratives in media actually matter a lot more. And I'd rather have a seat at the table than just be a silent voice in that. And I think media is going to be way bigger as things get commoditized. And that's sort of what my theory is on the AI productivity boom. But it's scary to be like an investment banker. I can basically have an investment banker that can tell me how to price my high yield bonds, or what company to buy, in my pocket now. And think about that. Or if I want to IPO or do a direct listing, I can do that all through AI. It's scary for white collar positions. I'll just say, like, the last 4 years, if that was left brain, capacity, where you got paid if you were a software programmer, an engineer, or all these things, the next 40 years are going to be about like the right brain, like emotionally. It's scary, but like new religions are going to pop up. One of the things that I think is a secular theme is like, if we went for, the last 20 years was very nihilistic, you didn't believe in anything. I think you're watching like rates of religious adoption, grow massively here, because people have to believe in something. They can't just, be empty vessels. Like, what are we doing here? Are we just like a fart in the winds of time? I think these questions, when you're on Maslow's hierarchy of needs, and like everything else is good, make money good for you, and everything else is free, then religion is going to actually like really come back, and hopefully not a bad way, in a good way. So I don't know. I'm kind of hopeful about the future and all that stuff.
Yeah, and the people who've been hopeful have been the ones who've benefited. historically, so it's the way to go. I do have maybe a very abstract thought about demographics, the impact this could have on demographics moving forward. Because I think if we look at the historical thinking or how we look at demographics, if you're an aging population, that's negative, because you need constant new people entering the economy basically to fund your countries.
Yeah,
But
not only
that
that,
could
but
potentially, yep.
like, you actually need someone to take care of you. And like, think about like the productive capacity that gets taken away from the economy. Like my dad had Parkinson's and like he was in he passed away, but like he needed a lot of attention as he got older. Like think about that across the world. When China's have a population collapse, we do. I think the UK does. Like it's kind of scary.
Yeah, but have you ever thought about where it actually might be beneficial if we go into this robotic AI economy, because you don't have this young population who want to do things or who aren't occupied and who don't have, all they have is entertainment. So that could actually be destabilizing to have a young generational population versus having an older population who's happy to retire and who are being looked after by all these robots.
Yeah.
Have you ever thought about that? It's very abstract, but this is something I've thought about.
I love it. This is stuff people should be talking about. I don't know. I dig these type of thoughts because that's the future. I mean, robotics is like becoming a real thing, and maybe some of the mundane tasks like doing dishes. If I don't have to do dishes at night, I got 3 kids, so I'm like, there's so many goddamn dishes. So I can have a robot do that. I'd be so much more productive. Sorry.
No, that's okay. Yeah, I agree. It's like trying to get rid of all those things that you don't want to do. But yeah, it'll be interesting to see how this shapes, I guess, what we think of as the ideal economies and the ideal countries, and what's going to, I guess, benefit in the future. Maybe it'll be the countries that have massive exposure to energy, like the Saudi Arabia's, the US, and Australia's, those type of countries.
Yeah, one little alpha generating thing is, this is probably pumping my own books, but like I do think this is a powerful theme, is like it takes 90 gigawatts to get to AGI, artificial general intelligence. And right now I think the US is at like 25 gigawatts of power. So they need, a whole lot over the next 3 or 4 years. It's why you're seeing all these giant deals like for access to power. And the Bitcoin miners actually, they're transitioning to be providers of energy or electricity to a lot of these hyperscalers. And the Bitcoin miners have, I think, about 6 gigawatts right now, going to about 11 or 12 gigawatts of that 90. They're sitting there and they're already kind of grown. It costs a lot to actually like grow that energy from the ground up. So they're sitting in this spot in between for all the hyperscalers to pay them for their access to electricity. And I don't know, it's an interesting theme I'm watching. Recently, like TeraWulf got paid, I think they were $2 billion market cap, and they got paid like 6.7 billion in revenue over the next couple of years. I mean, the stock should be absolutely like at $20 by now, but this is not investment advice, but it's kind of wild when you see these numbers. And then the fact that, Powell just said cost of capital for more risky companies is going lower. So I don't know, that energy theme, like nuclear power is going to be huge. Any of those like nuclear companies like the Cameco and NextGen is the Saudi Arabia of uranium. That's in Canada. That's kind of an interesting theme to play. So I agree. Like we're behind it relative to China on, electric capacity. Is like China actually invested in that infrastructure. And now I think that's part of the reason we can't have a recession, because like China can't beat us in the AGI race. We need to really like push that energy infrastructure investment to catch up so they don't beat us. And that's this new AI space race is what I call it. That's the themes that are like really the most important the next couple of years.
Yeah, Ken, those are the sort of things that you were talking about before, where it's like these frontier market or frontier sort of investments that you think are going to potentially outperform in the coming years.
Yeah. And I mean, the government's backed a lot of this stuff. Like they need this so badly. like space specifically. If you looked at the big beautiful bill, like a lot of space companies got a lot of that money, and they'll get a lot of contracts because space is where uh, the next generation of wars is actually going to happen in space, and like data servers are actually going to be put up into space because the cooling costs are a lot lower, and it doesn't sap our electric capacity here. There's a lot of funky stuff that's actually becoming economical up there. So I don't know. I think that's where you got to have a little bit of your money. It sounds wacky, but if you look at launch costs, they've dropped massively. And I pump, and for guidance, I've been pumping this company called Rocket Labs. That's basically like the public version of SpaceX. They're a second leader of launch, and that's an interesting one to watch. If trying to give you a little, don't follow this dogmatically because markets can change based off of policy, but right now it's looking pretty good with where Powell's at.
Yeah, no, thanks for giving us that those few pieces there. Appreciate it. But
Yeah,
so
not investment advice.
yeah.
This is not investment advice.
Go buy. No, I'm joking. Don't at all.
Lever up.
Definitely not a good idea. But yeah, Tyler, thanks so much for your time. I really appreciate it. We've gone in so many different directions and covered a lot, so appreciate that. But my last question is, what is one message you want people to take away from our conversation?
Oh, geez. I mean, I would say, be cognizant about what you're investing in. I think a lot of people just, they don't think about it and they let other people do it. And then you end up in a society where you're controlled by the very things you're funneling money to. And I really hope the next generation can do that better and not think about it as just this outsourced thing that you give to some guy in a suit that doesn't give a shit about the world, because you end up creating the very environment you're living in by continuously doing that. And like I hate to say it, like there's a lot of good things that like Meta does, but like giving the next generation massive amounts of ADHD and emotional issues through like Instagram and scrolling and all that stuff. 7 cents of every dollar that goes in goes to Meta of the S&P, and that automatically gets functioning. You got to be more cognizant about where you're giving your money, even and it's hard to do, but I think that's a really important thing for the next generation.
Yeah, it's a really important message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Yeah, I'm starting up a new gig with Carson Block at Muddy Waters, which is kind of funny because I'm, here talking about the Ponzi scheme, but Carson's a famous short seller. He's an activist short seller, and he has a couple other long-only products, Metals and Mining Fund. But I'll be starting working with him on September 1st. So reach out to me there. You can hit me on Twitter. It's basically in a Ponzi scheme, there's gonna be a lot of frauds. There's gonna be a lot of sociopaths, and we got to make sure that people don't take advantage of the system. So I'm trying to existentially align who I am with what I do for work. So I'm really excited about it, and that's where I'm at. But hit me on Twitter. I'll always respond to DMs there.
Yeah, great, perfect. I'll put in the description. It's definitely important with, as you're saying, with sort of borrowing costs going down. There'll be a lot more of those scammers out there trying to, become rich.
Exactly.
Yep, perfect. Thanks again for your time.
Thanks, man. That was awesome. Take care.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.